Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from Chartsandmarkets.com runs down the major markets. The shine came off Nvidia stocks, but healthcare and silver had a very positive week. Ross checks out gold in the U.S. and Canadian dollars. Publisher of the Schachter Energy Report, Josef Schachter, gives us the lowdown on everything connected to Canada's oil patch. He has a theory about why the northern pipeline through BC from Alberta may go through. It's connected to the U.S. Navy gathering forces off Venezuela. Joseph also has a special offer for our listeners. The founder of the TrendLetter.com, Martin Straith, comments on whether the S&P will continue to make new highs, why Nvidia is suddenly no longer the darling of Wall Street, and he gives us his goals for gold and silver. Martin has a Black Friday special for you. CEO of InkResearch.ca, Ted Dixon, is optimistic about the Canadian economy and points out the Canuck stock market was very strong this year and tells us why Canadian oil stocks performed well during low crude prices. He also has a 50% off sale for joining the Canadian Insider Ultra Club. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from Chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
And nice to be back. Thanksgiving in the U.S. and Black Friday as of, I guess, both sides of the border.
Which started about 2 weeks ago.
Yeah, it all starts online way beforehand, and then you can even go to the store and do a person-to-person sale. So, big week though for the markets. Quiet in terms of volume, but some pretty big price action out here. A week ago, the major indices, S&P, Dow, NASDAQ, all had dropped to the better part of about 3 weeks or so, and down to their 20-week moving averages. Historically, that is a pretty key level, and this is the first time we've tested that moving average since the market bottomed out in April. Since then, we're back, and indices have recovered about 60% or more from their lows. The AI stocks, they're bouncing, but not as well. I mean, in particular, look at something like Nvidia, really not doing a lot right here. Leadership has definitely changed. If you want to see the big winner out there, it's the XLV, which are the healthcare stocks. That is just has got power to the upside. So Thanksgiving in the U.S., typically like any long weekend, you tend to see strength around the holiday. Actually, Fosbach wrote this up way back, and I read his book back in the 1970s. Clearly, then, with Dr. Zimba, we came up with the work as well to show that from the days prior to a holiday and the few days after, there's just a strong bias to the upside. We are seeing that right now. And when we look back on Thanksgivings historically, the action tends to peak out around the 4th to 5th day after the Thanksgiving holiday. If the move is strong enough to make a decisive new high, and we're not doing that as of yet, but if we start to make a decisive new high, then the pullbacks become very mild, just like to the 20-day moving average as you progress through December. So we need to watch pretty closely starting this first week of December to see if the buoyancy off the bottom has much power behind it. If not, we could find ourselves right back and retest that low that we had last week. So for now, there's the biases to the upside. The credit side of the equation, when we take a look at the high-yield bonds, we take a look at the CCCs, they are not moving to new highs, so there's no leadership on the upside right now. There is still, as I say, probably if we don't gain momentum, we could be right back to the levels we saw a week ago.
What's going on with gold and silver?
Well, guess what? All-time highs in silver. We're at $56 on the spot price today. That is, by a long shot, the new high. And it's been a pretty exciting week for gold and silver bulls. The silver market, pretty much uninterrupted move here since a month ago. And clearly, the correction was... it was reasonable. We got down to about $46, but the movement to the upside, I didn't think we'd take off as quickly as this, but we are into the seasonal favorable period for both silver and gold. December through January is what you want to be looking at. The gold market, I think the key level to watch here is around 42 and a quarter. We're 42.22 as of the spot price today. If it can punch through that resistance, then it could do maybe a bit of a catch up to silver. But as always, when you're in a run in the silver and gold markets, silver tends to outpace. Now, the silver stocks, if you take a look at the SIL or the SILJ, they've been doing pretty darn well. And if you took a look at the gold stocks, if you take a look at, say, the GDX divided by the spot gold price, it's been outperforming gold since the December low. Had a pause for a month or so, and it started to once again show leadership to the upside. So, you could be long either in the silver, or if you're in the gold side of the equation, you're probably going to do better by being into the miners rather than into the bullion.
What's going on in the crude market?
59.50 as of the close of the week. And, this has been one that's just grinding its way lower. And as of now, there's nothing to say other than that. We would be looking for an ideal low December through January. So we'll look for some basing action, but it doesn't appear to be in place just now. We have, if we take a look at, thinking of energy, the uraniums bottomed out a week ago. We got some nice signals there for the bottom, rallying a little bit off the lows, nothing to write home about, but that looks like a pretty good low that we've put in place. And they've had a nice correction. You take a look at Cameco, that was 110 down to 80, and we're back to 88, so volatility. But looks like we have a nice low in place. One of the biggest items out there in terms of the flags on our indicators was in Bitcoin. There we end up with a downside exhaustion signal, and these are pretty rare. We don't get to the point where you have not only just sort of downside movement, but to an extreme. And that was in place here within the last 7 to 10 days. And the upside reversal, this probably has some pretty good legs. Usually the first rally off the bottom like this in Bitcoin peaks out about a month later. So we're a week into this run right now. Probably has some chatter, but overall the trend is going to be buoyant for the next 3 weeks, let's say.
What's going on with the U.S. and Canadian dollars?
U.S. dollar had, after the double bottom, had that nice rally up to 100. Tested that twice. We're back to 99.5. It's looks as though it's still basically walking its way up from the September low. And I think that we need to see this, probably 99.25 level hold to keep the uptrend in motion. It didn't take much of a setback here in the U.S. dollar from this last 3 or 4 days, just a minor move from 100.3 down to 99.5 to put a fire under the precious metals. So we'll see what happens in terms of the dollar right now. Canadian versus U.S. They're got a bit of a double bottom here at 70.25. We're back to 71.5 as of right now. And, it's moving opposite to the U.S. dollar. So if the U.S. wants to hold in, then probably we see strength or weakness once again in the Canadian dollar. No leadership when we take a look at the commodity prices and the oil market versus the Canadian. So, no divergence as of yet to write home about. We'll look for that to provide maybe some guidance as we move through the month of December.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from Chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Josef Schachter, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Josef Schachter, founder of the Schachter Energy Report online at SchachterEnergyReport.ca. He's speaking to us from Calgary. Welcome back to This Week in Money.
Oh, it's great to be with you again, Jim.
You, before we went on air, described the look on Danielle Smith's face, the Premier of Alberta, today. Why is Danielle so happy?
Well, they've been negotiating for quite a while and explaining to the Liberals and the Prime Minister, Mark Carney, how economics works and, how do we, if we have more and more problems with the United States, Carney keeps on talking about doing more business with Europe and Asia. Well, here's the way to do it. We have grains that could go to both sides, both Europe and Asia. We have potash, fertilizers of other kinds, nitrogen fertilizers. We also have natural gas with the LNG Canada now ramping up, maybe a BCF now, heading to 2 BCF in Q2 of 26, which is a big export number, and very positive for the industry. And then you take into account, the potential expansion of oil movement to the West Coast. And a lot of that is because of carbon capture being agreed to. The stages that had been in the prior, Trudeau game is over. It's now more longer term, and everything has to move in parallel. You've got to have pathways move forward with the carbon capture, which is now economic, and they have the technology for it, and more being developed all the time. Then TMX expansion. Then you've got to get a major player in the pipeline business to say they want to be involved, and a major buy-in by First Nations who see the economic benefits. So, and you have all of those loan guarantees by the BC government, Alberta government, Saskatchewan, federal government. So the money will be there for First Nations if they see the rationale with jobs and opportunities for their people, and a big economic benefit, which is what will happen. So today was a very important day. Danielle was smiling because the work that they did has benefited the go ahead for this. And the negative things like the energy industry not talking about how good they are on environmental and all the things they're doing, which there was a federal law saying you can't talk about it. Now that's gone. So we could be exporting clean energy technologies, including carbon capture and methane capture and all the other things the industry is doing fabulously to the rest of the world, which again could be our energy service industry, not just our oil and natural gas production, but the way we do it, the clean way we do it, which is the best in the world, that it could be a very big industry going forward.
Premier Eby of BC is dead set against a new pipeline going through the northern part of the province and for tankers going along the west coast. Do not tankers from Alaska go along that very same coast?
Absolutely, and he has no veto at all. There's no veto allowed in this deal. Federal government controls the waterways on the east coast and the west coast of Canada. So the question is just going to be, I would say the more important question is First Nations buy-in. If they agree to have the pipeline go through their lands and it goes to the coast and they have ownership in it and it's got the tightest, environmental controls, so no leakages from the pipelines, and all the things that are needed to cover their issues of sacred lands, then I think we have a go-ahead. But the cost is going to be very expensive for a 1 million barrel a day pipeline. I don't know if it's 30 billion, 40, 50. We all know how much the TMX expansion costs, which was, quite obscene, and the federal government's going to have to take a write-off at some point on it before they sell it or before they want First Nations to buy in. They're not going to buy in at the cost the feds have spent. They're going to want to get it one where there's an economic return. It may not be 20%, but they're going to definitely want an 8 to 10% return on the capital they put in. So it's going to have to be something with a write-off before anyone wants to buy parts of the TMX. And if there's going to be an expansion here of compression and others for 300,000-400,000, everybody may just wait and say, okay, let the Fed spend. If they overspend or they gold plate it, once it's all done, then they can say to the Feds, okay, we're ready to buy in, but you may have spent $50 billion on it between the purchase and all the rest of it and the expansion. We think it's only worth $15 billion on an economic basis. We're willing to buy 10% for $1.5 billion. And of course, the lending of it is coming from all the different governments. So, that's the way it's going to have to be. The Feds overspent. All the blockages that were put in by the prior NDP leader, cost a lot. Local, bylaws that were put in the way, protesting, delays, all the things that made the TMX so expensive. Hopefully will not be in the next phase. But again, anyone who buys in are not going to want to pay for those mistakes.
Everybody who's got gray hair remembers the Exxon Valdez accident in Prince William Sound in Alaska that spilled, 100 million barrel or 100,000 barrels of oil. But since then, legislation has been passed around the world that oil tankers have to be double-hulled. How many major accidents have happened since they've enacted that double-hulled legislation?
The only thing that I can think of is that sometimes in the Red Sea and near the Straits of Hormuz, there might have been tankers that banged into each other because they may not have had all their, especially the shadow tankers owned by Iran and by Russia. There have been some, knock-in. Some of those are also still single-hulled. But anywhere you go into an OECD country or even China, they all want the double hulls. They want the security of knowing that there's going to be no major accidents. And so, outside of little things that have happened away from the main, countries of the economic world, be the OECD and China, I don't think that there's anything to worry about.
Premier Eby says the weather up north is terrible. Don't we have satellites and other forecasting methods now that can help keep the ships away from that bad weather?
Oh yeah, and they know when to go. It's like if the air, if there's major storms or there's lightning, they delay flights, or they make sure that they de-ice if there's an ice concern. So look, they know how to do this stuff. They've been doing it for decades, and the technology gets better and better. And so the companies are not going to take a risk, and the insurance companies will probably have, provisions that say you can't go on these, if this is how bad it is. So I don't think anybody is stupid anymore to do anything in an OECD country. If something happens in the third world, that's a whole different story. They've got typhoon issues. They've got all kinds of problems weather-wise, but even they don't want to have a major disaster on their coasts.
Joseph, if this pipeline does go through, will it ultimately be a big economic benefit to Canada?
Oh yeah, but it's probably somewhere in the 2030s. If it gets it takes a number of years for the pipeline route. Even though Northern Gateway did a lot of the work. But again, the First Nations may say, no, not that way. It's got to go different because it goes through, special lands or holy lands or whatever the terminology is appropriate, sacred lands. So we probably will see a change in that route. But I think the key thing is that another million a day going to the west is important. The reason I think that the federal government changed is, if you go back to history, Venezuela was producing under American ownership of the resource there, the Orinoco Basin. Venezuela was producing at the high 3.5 million barrels a day. So they were a very big producer. And then, of course, when Chavez expropriation happened, they've gone down to below 900,000 barrels a day. So you can see that there was, a 2.5 million loss. If you take Canada in 2005, when they did the expropriation by Chavez, we were only producing 2.5 million barrels. We now produce 6.1, and of that, over 4 million is synthetic, going into the Midwest and into the Gulf of Mexico to the refineries that used to run both Venezuelan heavy, mostly of that, and some Mayan, which was the Mexico version of heavy oil. So we benefited when Chavez, nationalized the oil and gas industry and chased all the American companies out. And then, of course, nobody would buy their oil. They didn't know how to run anything there. They fired all those workers, if you remember through history, that were the ones who were running things efficiently. So they're now, if there's a change in regime, Chavez, Maduro, and narcotics, czar's gone. If the military, doesn't do a junta takeover, and the free elections that the opposition won, or the elections that the opposition won, 80%, but Maduro changed that and arrested them all, or he chased them out of the country. I think that if the Americans with that, the Gerald Ford carrier group, which is the most efficient carrier the Americans have with all the other Marines and special forces in the area, I think it's very short life for Maduro. I don't think he'll be around by the middle of 2026. And if at that time a new government is formed and they say we will give back the nationalized properties, then in a year or two we could see the energy industry producing 2-3 million barrels again. And and it'll be heavy crude that will, if it's run by the American companies, ExxonMobil, Chevron, all those guys who used to work there, that oil would then go into the Gulf of Mexico refineries and maybe even into the Midwest refineries, and we will lose that market share of 2 to 3 million. So that's the desperation that everybody sees a decade down the road, that if we don't get more West Coast takeaway, we are shafted. And I think that is something that Carney finally sees the writing on the wall. And I think the Americans have been very clear they want regime change. Chevron is operating there still, and I think the Americans want them to be there as their eyes and ears, so that when there's a change in regime, Chevron would expand quickly, and then ExxonMobil and all the others would go back in once they get their expropriations back. So I think this is this is the long-term problem that Canada had. And yes, there might be some more, pipelines from Enbridge into the States, but that's not going to matter if if Chevron or Exxon has owned production in Venezuela, they can move it to owned refineries in the Gulf of Mexico and in middle of the United States, and all of a sudden it is cheaper to move oil from Venezuela to the Gulf Coast than it is to move it by pipeline from Alberta to the Gulf Coast. So all of a sudden we are going to be behind the eight ball, and we need to find more markets. That's the wake-up call, and why the MOU today is so important, because it does give us traction a decade from now. If we get 300,000-400,000 more with the TMX, if we get 1 million with this new pipeline, if we use more rail, which of course we prefer to use pipelines, then we can offset the damage that would happen from losing that market share in the United States. And that's something that hasn't been talked about, but I think in the background, those in the industry realized it. And so that's the pressure that I think Carney finally realized, that this is a very big problem for us, but nobody wants to scare anybody by making everybody face the reality. And I think, but now that's the pressure that EB will be under, because it's going to damage, the fact that, the TMX is going to be expanded. Lots of LNG will happen, more export capacity for grains and mining, metals. We've got to do everything we can, because we're going to, number one, lose market share to the Americans because they want made in America. And second, we're going to lose, because the Venezuelan oil, which is the biggest reserves in the world for heavy oil, the Orinoco Basin, if the American companies that lost it under nationalization get it back, it won't take them more than a year or two to get that production up and running. And that's our long-term problem.
Joseph, what's new at the Schachter Energy Report, and how can our listeners subscribe to it?
Well, the big thing is we're going to have our webinar tonight, Thursday night at 7 o'clock in 90 minutes, and we're going to have 2 Q&As, one on the macro side of the things we were just talking about, and then we'll be talking company-specific thereafter. I know this show comes on the weekend, but we archive everything, so the webinar that happens tonight will be on the website for subscribers starting on, I think, Saturday. So early next week, people can subscribe. Also, there'll be something in Substack, in Twitter, and in LinkedIn where there's $100 off. So people should wait for that special holiday season offer, which starts December 1st. And become subscribers, get access to the webinar tonight. And I think we're going to have, the price of oil, you and I have been talking for months that I thought it would break 60. It's done that. It got down to, low 57. It bounced to 59 today. I think it's going down again. And I think we're going to get a buy signal sometime either late December or in Q1. And I think that's going to be, we had one fabulous buy signal in April. If you remember, we said it was a table-pounding buy. Stocks did exceedingly well, some up more than 100%, many of them 60, 70%. So while everybody thinks about tech and, all the AI world, the energy sector performed well, despite, the focus on the technology world. So I think people should look at, becoming subscribers. Again, as you said, www.schachterenergyreport.ca. And as of December 1, there's that holiday special, and people can then get an annual subscription and then be part of our, the webinars, be part of the 2-a-month regular issues, and then the weekly Eye on Energy, which is the macro piece that you get, which shows our views on what's going on in the economy and everything geopolitical that can affect the energy sector. And it's gotten a very, very high profile globally now, that, from a product that was created in 2017 just for, Canadians or Western Canadians interested in the oil patch. It's now got a global reach, because the product, carries itself and, people find the benefit to it. So, there's a lot to benefit from the product we put out. We've got a great team putting it out. We're going to be expanding that team in 2026 so we can do even better. So, all I can say is kudos to the team and, the results and the subscription growth in 2025 has been exceptional.
So far this year, West Texas Intermediate Crude WTIC's traded below $60 a barrel in April, May, October, again in November. These sub-$60 prices haven't been seen since early 2021. Where do you see this West Texas crude going?
Well, right now, we've got two issues in front of us. Is there going to be a deal between Russia and Ukraine? And the negative people, the ones who say below 50 or below, definitely below, 60, but definitely some of them are throwing around numbers in the 50s or lower, is they believe that Russia, which is producing about 9.2 or 9.3, let me get that data, 9.3 million barrels a day, will be able to bring that production up to 10, 11, 12, and that would glut the market. So the number for October was 9.38 million barrels. So the largest producer is the United States at 23.5 million barrels. Then you go to Saudi Arabia at just over 10. 9.38 is Russia. Canada is 6.1. We are the fourth largest producer of oil in the world, and a lot of it is because we gained that market share from Venezuela, and if we lose that market access, then we need to find new clients, and of course Asia is the best place for us to do it. You can always do rail into Eastern Canada, but again, I'm not a fan of rail. There's talk about if you do pipelines to the Great Lakes and then move it by ship. A lot of people talk about Churchill making it not only a great export market for grains and potash and nitrogen, all that stuff, but also energy, oil. So there's lots of potentials, but it needs buy-in and it needs the environmental and it needs First Nation support. But we're going to need to find new markets because I believe we will lose in the next 10 years 2 million barrels a day that we now ship to the United States.
Do lower oil prices lead to lower price inflation and a strong economy?
Well, lower prices have been the only good thing that's happened on the inflation front for Trump. Everybody else going into their Safeway store or what equivalent is finding everything else. Meat is up like crazy, fruit, vegetables, everything. So lower prices help for oil on the inflation front. But if you have a strong economy and demand goes up, then all of a sudden you may not have enough supply, and that's when prices take off. And 2008 is the perfect example. In the beginning of 2008, we were about $80 US a barrel, and then there was no new supply. Inventories were coming down fast, and the price of oil, if you remember, went up to $147 in June, July. And then, of course, we had the financial crisis hit, and the price of oil fell when everything else fell. So if you have a strong economy, that's a negative for higher prices, or a negative, for the economy and a negative for us as consumers, because the price of oil would go up. We're sitting right now in Calgary at 114 a liter. We were, 135 just a few, weeks ago. But, we were, I think 170, 180 when we had, $100 oil, $120 oil when you had the Russians' invasion of Ukraine going back a few years ago. So bottom line is, higher prices helps the companies and helps the job market and helps provincial revenues because of the royalties that they get and the taxation that they get from the jobs and the profits of the companies. And so, there's benefits to high prices, but there's negatives as well. The big one I'm concerned about is in Alberta, they've made the decision that data centers cannot go into the grid because the grid is full, and they do not want consumers to see, 50%, 100% increases in their power bills on a monthly basis. So they've said, the premier said, that anyone who wants to build a data center in Alberta, in which we want them to, because we have cheap natural gas, and of course, remember, they throw off a lot of heat, so our winters help out in terms of lowering their costs of cooling their facilities. But they're going to have to find and build their own power, which means they can do natural gas powered power, or they can do at some point these modular reactors that could be coming our way. But the technology's still not all done. But we know that wind and solar really aren't going to be able to be the solution. You may use it as part of the power, but you're going to need the base load to come from natural gas. And again, we're seeing some companies doing deals. We talked to a lot of companies that say they're in negotiations about big data centers, including Tourmaline, the biggest natural gas producer in Canada. So I think that in the months ahead, now that this MOU is in place, we'll be hearing a lot more about data centers in Alberta and also probably in BC.
Geopolitical unrest, Russia versus Ukraine, Venezuela, China, Taiwan. Could this put a base under the price of crude oil?
Well, I think the base is going to be the mid-50s because it's uneconomic to drill a lot of wells anymore at those prices, even though the Canadian dollar is 140. So it helps there. But we're going to see differentials widen. And again, if we do see Venezuela come back on with American management and ownership, then we're going to see the differential widen for anybody in Canada who wants to sell heavy crudes into the States. So that's a nasty negative. In terms of if the Americans invade Venezuela like they did in Panama, I don't see that as good because there's Russian troops in there. There's Cuban advisors for the intelligence services. It's going to be nasty with a lot of casualties. So I think the pressure they're bringing, which maybe they go after all the military side, maybe they go after all of the narco facilities to build the narcotics. That would be probably the way to go in Venezuela rather than land troops. Russia, Ukraine, I'm hoping it goes forward. The big battle is going to be over land concessions, but it seems that Zelensky and Ukraine are willing to talk about it, which is something they wouldn't have done in the past. I believe that sometime in the next 10 years, Taiwan will be part of China. Does that go through a democratic vote, or does that go through blockade of Taiwan, which kills their economy and forces them to the table, or does it mean invasion, which I hope doesn't happen, and more lives are lost. But I believe that in the next decade, Taiwan will not be independent.
It'll be Taipei.
It will be Taipei, which is the major city, and just like we saw Hong Kong, just like we saw Macau, just like we saw other places where China over time got them as part of China. And I think the arrogance of the Americans to think that they control the world, they are the Rome, or they are the Parthians or the Persians controlling Asia. The Americans have stretched themselves too far. They don't have enough, soldiers. They don't have enough aircraft carriers. They have 11. Only 5 or 6 work at a time. China now has 3, and their newest one is as good as the Gerald Ford, which is the newest, carrier that's right now off of in the Caribbean. So China is going to exert more and more of its power in its own area, just like the Americans have the Monroe Doctrine, which says, nobody plays in our North America and South America. I think China is going to exert its power and say to the Americans, this is our backyard, get the hell out.
Are sanctioned countries finding ways to move crude oil?
Oh, the Russians and Iranians have done it with the shadow fleets, and what they can do is they can change the name of the ship or change the color of the ship and repaint it, or they can move it offshore and move it into other vessels. A lot of what the biggest thing now is Indonesia, which right now doesn't have a lot of oil to export. They put in an Indonesian vessel maybe 10% Indonesian crudes, and then fill it up with Russian or Iranian crudes, and then sell it as Indonesian crude. So I give Iran and Russia a pat on the back for finding a way around the American sanctions. If there is a deal over Ukraine, and over time, the battle and the deaths are over, and the Americans allow them back, the Russians back into the SWIFT system, I think we're going to see, that the downside in oil will be removed, and if we see strong economic growth, that demand growth, if it's not 1 million, 1.2 million, and grows to 1.3, 1.5, because the emerging world, starts, bringing on more copper, more nickel, more lithium, all the things we're going to need for that transition, that's going to be positive to the demand side. And I believe on the supply side, we're not bringing on enough. The big thing people talk about is, there's more oil coming from Guyana, more from Brazil, more from Azerbaijan. Absolutely. Maybe it's 800,000 barrels a day, but if demand's going by 1.2 to 1.4, not enough. The thing they miss, and this is something I bring up in all of my presentations, is global depletion is about 5%. So if you have 105 million barrels a year of consumption, you're losing over 5. You have to come up with 5+ million barrels of new capacity, which we are not doing. And so the pessimists are missing that point, or they're ignoring that point. And if you take into account new wells in North America, be it the Permian, or be it the Eagle Ford, be it the Montney or the Duvernay, the decline rates are very sharp. They're 40-50% in the first year. So I think people are really ignoring this depletion issue, and that is the most bullish portion for the story, because if demand goes from 105 million this year to 110, 112, in the early parts of the next decade, we're not finding enough now to replace declines, and then we need to have more for the growth that's going to be needed in the emerging world, not in the OECD. OECD demand will continue to decline year over year over year, but the non-OECD, the emerging world, Africa especially, South America, parts of Asia, that's where the game of more demand is going to come from, and that means we're probably going to see much higher prices to entice the capital back to invest in the ground and bring on more production.
What's the latest on rig data?
Well, I've got the data that came out today, so instead of using a week ago data like we had other times we've talked, the U.S. rig count fell 10 in the last week to 544 from 582. That's down 6.5%. When you break that down, the gas rig count went up by 3 to 130 versus 100, so up 30%. But the oil rig count, again, these low oil prices hurt, went to 407, down 12 on the week from 477 a year ago, down 14.7%. In Canada, again, we lost -7 to 188 from 205 a year ago, down 8.3%. And in terms of natural gas in Canada, the rig count was only down by 3, so down 4.3% from 70 to 67. But the bigger decline was oil, down 7 on the week, from 134 a year ago to 121, down 9.7%. So, these oil prices are not providing the incentive for companies to spend money unless they're very good wells or they're committed to drill these wells earlier. And I think we're looking at, we need $70, $75 oil to get the capital back. I think we're going to see $70 oil in Q2 of 2026, and I believe we'll be looking at $80 oil in Q4 of 2026. So I'm big and bullish on the long term. I think the issue is the next few months, and a lot of that's geopolitical. A lot of that could be, the billion barrels of oil that's floating around the world. That's Iranian, Saudi Arabia, Venezuelan crude that needs a home. And again, sanctions being removed from Russia especially means oil can flow to the buyers. Mostly it'll be, China and India. But the discount, right now they're getting a benefit of $20 a barrel for the shadow fleet deliveries. But that could shrink to 8 or 10 versus Brent, which means Russia gets more money in the door. But the China and India benefit of buying that versus Saudi or Canadian still gives them the incentive to be a buyer of Russian crude.
Bullish case and bearish case for crude.
The bullish case is economic, strength going into, future years. and also, the Russia-Ukraine war being over, and the bullish case, you could argue, would also be if there was any trouble, the Houthis, with the Red Sea, anything that happens in the Straits of Hormuz or the Straits of Malacca, any problem with any of them, be pirates or whatever, that could drive the price of oil up. So there's lots of reasons, for the bullish case in the outlier years. In the meantime, what's the bearish case? The bearish case is weak economic growth, the tariff battle by Trump with the rest of the world, and especially with Canada right now, a health scare. We saw what COVID did to the price of oil in 2020, and if it's a flu situation or any other kind of health scare that requires the economy to be shut down or protected, that's where the negatives are. I'm damn hopeful that doesn't happen again, given how severe, the economic contraction was in 2020.
Is tax loss season a good time to buy large cap, mid cap, and junior oil and gas stocks?
Historically, that's been the case. If you have a weak energy price market during during the latter part of the year, this year we have strength. Number one, because of all the takeovers. We had MEG, we had Kawitna, we had New Vista, we had STEP in the energy service sector. So the market is taking who's next attitude, and they're pushing stocks up. Some of them even over the bids that are out there, like in the case of New Vista. So I think we've got a little bit of let's say, an overheated market right now. And I believe that if we do go back down $2-3 in the price of oil, and we get, concern about, the floating storage, maybe there's no Ukraine-Russian deal, quickly enough. The question is, what did the Americans do with Venezuela, and do they blockade them? If they blockade them, there's no sales there. So I think that, we may see a correction in the general market because of fears of war. That would bring down everything. And right now, just look what happened to Bitcoin, over the last month and a half. What was it, 128 at the high, and it was down at 82 or something. I think it closed today in the 90s. But anything below 80, a lot of the ETFs that people are buying with Bitcoin or all the coins has a break even around 80. If it gets below 80, those ETFs are going to see massive redemptions, which again, a lot of that is Gen Z and Gen X buying it. It's not elderly people like me that are buying Bitcoin. And so, and the gangsters are doing it, the mob, the drug dealers are all doing it, and anybody who doesn't want to be seen by, the American or Canadian FinTrack or the American FBI are playing in that area. But, if it breaks 80, I'd be very concerned because there's a lot of leverage in it. People were buying and putting up 10 cents on the dollar, borrowing 90. Well, if something goes down by 10%, you're dead.
The Federal Reserve's next meeting is December 9th and 10th. What do you think they'll do, and could it affect the energy markets?
Right now, the consensus view is it's going to be dropped by a quarter. There's not enough economic news. That we saw a little bit of retail sales, industrial manufacturing was lower. They're going to get a little more data by December 10th. The consensus, I said, is a quarter-point decline. It'll be the wording that matters. Are they getting more dovish, or are they mixed? Right now, I would say half are dovish and half are hawkish, and we don't know where Jerome Powell is at this point. So, and again, the president is going to probably appoint one more new person to the board. Will they do it in time for that next meeting? Because I think they have to be approved by Congress. So again, Congress goes on holiday in the middle part of December for the holidays. So, if the president wants to put in somebody who's going to push for a 50 beep cut, there's one person he's got on board who's in favor of that, but most are in the quarter point. Will that do anything for energy markets? No. Quarter points in there. The dollar, is the thing to watch. I think it's 96 right now. And I think, if it gets over 100, I think we could be looking at 104, 105. If there's any geopolitical war events, the U.S. dollar will benefit from flight of capital to the areas which are concerned. That would strengthen the U.S. dollar.
Are credit and debt markets concerning?
The treasury markets and the bank, the government of Canada and bonds are not the issue. Where it is in private debt and in leveraged loans, which is a big thing in the United States now. They create a lot of that shit in my book, and just like we saw with subprime, mortgage and products in 2008. I think this is a disaster in the making. The repo rates are now trading above Treasury yields, which normally are not the case. So we've got a problem here of liquidity. And again, real estate still issues a problem in many places. Regional banks have a lot of that. And again, if we see that the equity bases of the regional banks get in trouble, that would be a concern. And a lot of that will be, the real estate loans that they made a couple of years ago when interest rates were lower. The properties aren't worth as much. And of course, we still don't have a massive move back to the office. People still working from their homes. So I think that the real estate problem, private debt, and leveraged loans could be the iceberg that hits us at some point.
Corporate insiders have continued to sell record levels of stock, yet the stock markets keep going higher. Could corporate insiders no longer be the leading indicator of what they used to be?
I think they still are the leading indicators, and a lot of professional money managers watch it and take action, and they are deleveraging. Remember, if you bought Nvidia when it was, a third of the price, and you're a portfolio manager and you want to ride the horse while the performance is on, but when it comes to year end, and again we're not far away, you've got to rationalize how big a position you can afford to have, and a lot of them will say, okay, I can't have a 9% position, maybe a 4 or 5%, so they will be paring down their winners in the next few weeks, which could put pressure down on it. The other thing, we're seeing insider selling even from the AI and tech sector. Palantir, the CEO, while he was going out criticizing the short sellers on CNBC, he was dumping stock. So, I think it was $100 million of paper he sold. So these guys are, what they say from one side of their mouth and what they're doing, watch what they do, not what they say. And I think the corporate insider selling is massive, and I think it's telling something that the companies know their stocks are overvalued. They've stopped their stock buybacks and NCIB equivalents, and they're just trying to batten down the hatches for trouble ahead. And you're seeing more and more. The HP announcement, 6,000 job losses. You keep on hearing more and more company after company in different industries saying layoffs, and some of them are blaming it on the business, some are blaming it on AI, that is helping. And I think that the more job losses we see, that's bad for the economy, because who the hell is going to buy the AI products if they're laid off?
Could AI lead competition be causing more U.S. corporate bankruptcies?
First thing I think the question mark is all these data centers and AI products that they're building, are they going to be profitable? Are they going to find a big enough market? Are they priced to make money? The data centers, I think there's too many coming on. I think it's overcapacity, just like we saw in the dot-com bubble. And I think, there's going to be a day of reckoning here. And the big thing is, the cost of building the data centers, versus the return is an issue. The second thing is the cost of the power is very high, and we're already seeing a backlash in New England states where the companies that went in first were able to get very cheap power rates, just like we see, the enticements that we see in Quebec or whatever, in all other provinces where we give money to the auto industry to come and open jobs or whatever. That I think is telling you that, we may see AI bankruptcies in the years ahead, and too much data centers, and the efficiency and the profitability will decline. The hundreds of billions that you hear being thrown about are just obscene. I think we're hearing $1.5 trillion of data centers. How the hell can those guys make money? I think the big thing to watch is what's going on with Nvidia. Nvidia in their third quarter, talked about a fabulous net income versus their revenues, but they didn't say, and you had to go into financial statements, which I did, and I'll be talking about that tonight in our webinar. The cash from operations was a third lower than their net income. And I have a next slide after that, Microsoft, showing that their cash from operations was materially higher than their net income. So they're playing accounting gimmicks at Nvidia. And then you've got this new Google chip that's come out that Meta says they're going to buy. You've got Huawei out there. You've got AMD out there. Peak margins, I think, are there. And once you start having more competition, and even though maybe one chip is a little bit not as good as the Blackwell, if it's priced much lower, then you buy 2 chips, you buy 3 chips, and you don't buy the Blackwell. I think the Nvidia story is a bubble that's going to burst. People may hate that for me, just like they did, when everybody was in love with, Research in Motion or Nortel. Whenever you said a negative thing when I was on BNN and people were talking about it, they got booed and they got negative, people sending them nasty emails. I think we're getting the Nvidia question where there's some, we saw Michael Burry get bearish on it, and we're seeing, people, even I think Nvidia people were selling recently. So I think people should be watching what people do, not what they say. And the bubble, to me, on AI is bursting. It'll be data centers, and it'll be the chip costs. And if we start seeing the chip costs come down, because Huawei can take on Asian market because they'll buy from China, and if you have Alphabet with a hell of a good product that's competitive with Blackwell, and then AMD's got a new generation coming, I think the writing's on the wall that the cycle for the semiconductor chips is going to roll over.
Bitcoin is not asset-backed. Here it's a tool for money laundering. Is it belief in market psychology or rigging that prices Bitcoin? Bitcoin had, when it was, when the cost was like 15,000 and that was the value of the electricity in it, you could have said, okay, have some of it. But with the cost of electricity, 20,000 now, and the price, in the 90s, there's a lot of fluff in there, a lot of air in there. But, Gen Z, Gen X are in love with it, and they're leveraged in it. Anybody who's involved in money laundering or offshore accounts that don't want the Americans to see what they're doing or their own country, they're going into it, and they're immediately getting out of it. They want to transfer it to gold or something else, real estate. So I think Bitcoin had a use early on. Now it's very speculative. And, we saw it go from 128,000 down to 82. If it breaks 80,000 in the coming weeks, I think the writing's on the wall, the bell will be ringing that it's a rollover. And could it go down to 50 or 30? I don't know, 30,000, 50,000. But if it breaks 80, it's going down. Is China's economy in trouble?
Yeah, we've seen data about profitability going down, industrial production going down. Profits, of course, going down was the announcement today. The big problem is their property market, where they haven't taken all the hits. People put up a lot of money for apartments, and then they don't get billed, so they lose all their money. So consumer spending is very, very low there. And so China's economy, just like Japan's had to do when after they had the big run up in the 1980s. And they were buying, the industry was so powerful and money was flowing in. The yen was so strong. They were using that to buy properties, Pebble Beach and, New York properties. And then, of course, everything reversed and they had to sell them at a discount. I think we're looking at, China having difficult days, and it may take a few years for them to find new markets or resolve their trade deficit with the United States by buying more soybeans, by buying more tech, by buying more whatever the hell they can buy to tighten that trade surplus. They need to do that, more LNG, and you can do it. The Europeans are doing it. They're buying more LNG. They're buying oil from the States, not from Russia anymore. As to the degree Hungary's still buying from Russia, and the Americans. Trump gave the Orban, the prime minister or president there, that he's got an exemption. EU is trying to cut all Russian imports, but they're two-faced. We're going to cut everything, is what they say, and yet they buy product that they can't get in their own country, so they still do it through intermediaries. So there's a lot of hypocrisy here, and when the EU says something, I take it with about 2 grains of salt.
The Canadian dollar looks like it might put in a double bottom here in November. What do you see ahead for the Canuck buck?
I think we're looking at a 68-cent lower dollar. If I'm right, that we come down 2 or 3, dollars in WTI. If there's no, trade issue resolution with Trump before year end, again, year end, transactions can have an impact on the dollar. So I think that, we're looking at maybe 143, 145, maybe the low. But I think if we are right about, $70 oil in Q2 and $80 oil in Q4, I think we're looking at a Canadian dollar high 70s, maybe into early 80s, once we see a sustainable $80. And if we see this MOU turn into reality in terms of action, I think we can look at a Canadian dollar that strengthens, because the stronger the Canadian economy, the more we export, the more wealth, the bigger the pie, the more wealth, then government deficits come down, incomes for individuals go up, they pay more taxes. That helps the federal and provincial balance sheets. So I think that if the MOU goes through, and it's not only for oil, it's for all the mining things he's talking about, all of the other things for power with Quebec. If all of these things move forward, a bigger pie means a stronger dollar.
The U.S. dollar has been showing strength since mid-September. What are your thoughts on the greenback?
On the price I mentioned early 96. It closed today at 99.54. I had notes on that in that question. I think that the U.S. dollar, if there's any strife around the world, people will run to the United States. We're seeing a lot of gold being moved from Europe and other countries, South America, into the United States for safety purposes, into Singapore, and for to be held safely. And so I think there's a chance that if there is any geopolitical event people want to hide in the States, we could be looking at people buying using euros to buy U.S. dollars, buying more investments in the United States, and buying more T-bills, more 1 or 2 year treasuries. So I think the 105, 107 is a target for sometime in 2026, maybe second half. And if there's any activity in Venezuela in terms of military action against them, I think that would also be a positive for the U.S. dollar, because people will realize the Americans are not going to take any more guff from Maduro and the narcotics czars, and that Colombia is going to have to face this issue and clean up its act. Any other countries that have been making a fortune out of drugs and fentanyl into the United States are on the bullseye of the American military, and Trump's not going to. And I think Trump's got support in Congress for that.
Is it starting to feel like black swan season?
I think we just talked about that. Yeah, I think something's going to come out of the blue that's going to shake the market up. Is it Nvidia getting too much competition and lowering the price of Blackwell chips? Is it going to be something between Russia and Ukraine? Is it going to be? I think the one that people should be concerned about in 2026 is China blockading Taiwan. So they could just say no ships in, no ships out, no planes out, and effectively you totally deflate the Taiwan economy, and then they have to come to the table without any people dying in the process. So remember, the Americans blockaded Cuba when they didn't want Russia to send missiles in. So there's a lot of history where the Americans can't say anything because they did it. Taiwan could be blockaded very easily with the size of the Russian Navy, and they're practicing for that. And they have the planes, they have the ships, and that's why Taiwan is trying to spend a lot more money on anti-missiles and cruise missiles, because they're worried about China, attacking them that way. I think the easier way to get Taiwan to the negotiating table is a blockade, and I believe at some point, Taiwan is not one view that we are all in favor of independence. There's still a large number of people who voted for opposition parties that were in favor of an accommodation with China. So I don't think that, people can say, Taiwan does not want to unanimously be not part of China. But I think that, the government in power does. So who knows? But a blockade is probably the easiest way for China to get its leverage to get a negotiation started.
Do you think Prime Minister Mark Carney is working in the best interests of Canadians?
I think the wake-up call of the things we've talked about, be it the tariffs and that the United States is no longer going to take all of our goods, that unless it's under the MCA deal, I think that, Ontario and Quebec are suffering from the tariff wars, and we still don't know what's going to happen with autos. We still don't know what's going to happen with steel. We still don't know what's going to happen with paper and forest products, which are, there's been mills closing in BC. So I think that the issue is that he finally realized that he needs to move Canada from total, involvement with, 60-70% of our exports or more going to the United States, that we've got to find new clients. So they're talking to the UK, they're talking to Europe, and again, I don't see an oil pipeline going to the East Coast, to New Brunswick. I think Quebec doesn't want one through there, and I don't think Carney can throw enough bones to them to get them to change their mind. But could there be something at Churchill? Could there be something at the Great Lakes? And then oil go to? But I think that's that's going to take quite a bit of time. And again, I think that the going west is probably the easy decision for now.
Can you tell us again about your holiday special?
Yeah, I think that, we've talked a lot here, and there's a lot of coverage. So we have two products. We have just the Eye on Energy, which people can sign up for on Substack. But the full product, which includes the SER, all the company research on 31 companies, that's go to www.Schachter.Energy.Report.ca. Wait for December 1st when you can see on X and LinkedIn and Substack the holiday code. Get the $100 off the annual, and please join our subscriber group. We've had a lot of winners from the April low when we said table pounding buy. I think we're going to get another buy signal potentially in Q1. If we do, we could see very strong upside. And if I'm right about $80 oil in Q4, we're going to see a lot, 50% doubles in many stocks. And if I'm right about $100 oil in 28, we could see 5 and 10 baggers during the cycle. So I'm very enthused about the opportunities, but I'm patient now for that next buy signal. I kind of had our clients thinking be 80% invested, whatever your maximum weight is energy, and again, people in Eastern Canada would be lower than those in Alberta for sure. But whatever keep it at 80, your dividends come in, hold the dividends. And when we get the next table pounding buy, we send you out an action alert to that to all of our subscribers. That's when you decide, do you want to buy more of the pipeline companies? Do you want to buy more of royalty companies? Do you want to buy more E&P? Whatever is right, sit down with your investment advisor. But when the next buy signal comes, we're going to say it's time to go to a fully weighting, whatever weighting is appropriate for you. And that's not something I can help you with. That's something you go to your investment advisor and talk to them about what's right, given your investment approach and what your investment needs are. For people heading into retirement or people in their mid-years where they're still trying to build their asset bases.
Where can our listeners follow you and subscribe to the Schachter Energy Report?
Well, the subscription, again, I just covered that, and there's going to be the holiday special. I do a lot of, broadcasts so people can go and look on, Substack and X, and we put this interview that we do with you guys at House Street on our website, so any of our subscribers can see that. It's also, we note it to all those other, social media places. So, we love doing these interviews. We think it's important to be doing them to represent the energy industry and show that we're not a dead industry, but we are part of the solution for the long term, and that the ability for Saskatchewan, Alberta, and BC to be the leaders of the engine of Canada into the next decade is definitely there. assuming we get everybody at the table, and that means the governments, federal, provincial, that means the indigenous communities, and that means local community sign-off, and that the economics work. And I think that we're heading in the right direction. The announcement today with the Prime Minister and the Premier of Alberta was fabulous, and so you saw the number of people in the room and all the clapping and standing ovations when they spoke, especially when the Premier spoke. So it's a great day for Canada, great day for Western Canada. Now let's see if it's implemented.
Joseph, thank you so much for being on This Week in Money.
My pleasure as always, Jim.
My guest has been Josef Schachter, founder of the Schachter Energy Report. Our conversation took place on Thursday, November 27th. Coming up, Martin Straith, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
Oh, thank you very much, Jim. Good to talk to you.
In the investment world, results are the key. Your services have posted some nice gains recently. You have a Black Friday special offering your best prices of the year. How do people sign up for it?
Yeah, we've, in this business, you want to be able to provide subscribers with some nice gains. And, in the last 6 months or so, Trend Letter closed 7 trades, about 99% average gain. Our disruptors had closed 5 trades, 184% average gain. And the technical trader had 4 closed for 221% average gain. So that's nice. And yes, we do have some Black Friday specials. These are real discounts. So we're offering between 33%. So for a single subscription. So that's $200 to $250 off, up to 57%, or $1,050 off if somebody wants to buy all 3 subscriptions. And to get at those, all they have to do is go to our website, thetrendletter.com. So that's all one word, thetrendletter.com, and just click on the Black Friday banner on the homepage there.
Since late October, the S&P 500 pulled back by about 6%. Since then, it's rallied. So why the change in direction, and do you see it making new highs?
So that was since late October high, so a little over a month ago, or about a month ago. So the S&P pulled back. It tested its 50-day moving average, and then it fell through that level, and it tested its 100-day moving average. But right now, or recently, just this week, that 100-day moving average is held. And by the way, Jim, we're all about charts, and seeing these levels and seeing the trends and so on chart makes it so much easier to understand and to explain. So I'll post some of the charts that whatever we talk about today. I'll post them on our website so that your readers can kind of see what we're talking about. So then you say, well, why the dramatic change? Why did we had the big sell-off, around 6%, and then all of a sudden we've gone back up? Well, again, so far we're in another one of these buy the dip scenarios. For one, in a prolonged uptrend, which we are in, when you get these buy and dip mantra, people just want to buy it. So we get these fairly quick pullbacks or corrections, and then we get these V-shaped recoveries. And, at some point, the buy the dip stops working and every bounce gets sold. And when that starts happening, when the selling starts to feed on itself. So when every dip has been bought for years, investors they forget that one day the dip is not going to bounce. Instead, the selling triggers more selling. So investors, your listeners just need to be aware of that. I'm not saying that's going to happen today, but it's going to happen at some point, and you need to be aware of it. But for now, since last Friday, the market's been rising again. Now, why is that? Well, we got the Fed meeting on December 10th. Now, the odds of the Fed cutting rates, it has jumped from 40% just 2 weeks ago to, when I looked at it this morning, it was 87%. So another factor is the expectation that Trump is going to replace Powell soon. And the key is he's going to replace him with someone very more dovish, meaning somebody that is much more willing to cut rates and to cut them quickly. And so that would give stocks certainly a good boost in the short term. I mean, obviously, lower rates make borrowing cheaper. That supports spending. That supports investment. And that helps with higher company profits. So again, that's all positive for the stock prices. But if the Fed becomes too dovish, and I think that's going to be a concern at some point, and especially if they're dovish for political reasons. So if Trump, he puts in his guy, and his guy does whatever Trump wants, that's going to hurt confidence in the inflation control. It's going to hurt confidence in the dollar, and that's going to lead for more volatility later on. And also we need to watch next week we have the personal consumption expenditures. That's the Fed's favorite inflation data. If we get any hotter than expected prints on that could certainly reduce the odds of a rate cut, and that would put pressure on growth stocks. But another tailwind, though, is that late November through to January, that's usually a very good time for U.S. stocks. Many investors start positioning themselves for the potential of the Santa Claus rally, which typically comes at the end of December and early January. And we also typically see large, index trading funds, they start to shift more money back into equities. And then on top of all that, you get the short traders. So those are people that have been betting against the stock market. They start to rush in and buy stocks because they got to cover their short positions. So all of this can turn a small market rebound into a stronger, more sustained move higher. Right now, just looking what we got here, we got the S&P's at 6850. So what I'm really watching for now is a near-term resistance at 6860. So that's only 10 points higher. Then we got the all-time high at 6925. So the key for me is if the S&P 500 cannot break 6860, if that resistance level holds and we get another pullback, we could see the start of a larger correction. Now, if the S&P falls below its recent 100-day moving average, so that's at 6570, then we could see a bigger correction, say, 10%. Well, a 10% correction from here, that would take us all the way down to about 6150. But I think the odds are still pretty good that we're going to get that Santa Claus rally in late December into January. And, everybody has opinions, Jim, but, we're technical analysts. We watch the charts, and we look for those key support and resistance levels, and whatever the market does, that's how we react.
Nvidia has been struggling since its big earnings report. What's happening there with the world's biggest company?
Yeah, they had that huge earnings beat. Their revenues were up, what were they? I think 65%, something like that, year over year. The stock's down about 20% from the high at the start of November, so just in a little over, 3.5 weeks. There's a number of factors here. I mean, one is simply the valuation of Nvidia and some of these other tech high flyers. Just a few weeks ago, October 29th, Nvidia's market cap hit $5 trillion. Now, just to put that into context, that's higher than Germany's GDP, which is 4.6 trillion, or Japan's GDP, which is 4.1 trillion. At those levels, I'm surprised, or maybe I'm wondering if the CEO there started looking at designing their own flag and writing their own anthem, maybe. There is concern. There's another big concern here is the circular financing. And this is where, a lot of these, we're seeing this in a lot of these tech companies where Nvidia, for example, they're investing in some of their AI customers. So they're investing in OpenAI, CoreWeave, xAI, and then these companies then use that capital they just got from Nvidia, and then they buy more Nvidia chips and infrastructure. So, basically what you're doing, you're inflating your revenue without true organic demand. Another hit to Nvidia was the concern of competition from competitors like Google, so that was in the news last week. So the markets are getting a bit nervous here on some of these wild valuations and expectations for these massive growth. We could go on and on here. Another big one is we saw with Oracle, the credit default swaps are at 5-year high. That's telling the market that people are very concerned on the debt levels for some of these companies.
Related to Google as competition for Nvidia, you posted a blog the other day highlighting the key difference between training AI and inference AI. Can you explain? Yeah, well, and I think anyone who wants to read this, just to go up into our update section on our website. I think it helps. It's in pretty clean language. It's not real techie stuff. But as you say, AI is not just one big process. It's primarily two very different phases. So you've got the training phase, which is really teaching the model, and then you've got the inference phase, and that's basically using what it's learned and then putting that into the real world. So if you think about it, the training phase is like cramming for some huge exam. And so what the model is doing is digesting these massive databases, and then it's adjusting billions of internal settings. And so this training phase, it needs this enormous computing power. It needs a ton of memory, and it's got clusters of these high-end chips all working in parallel. So now Nvidia dominates the whole training phase today. They got their H100 chip and the new GB200, and they've got their CUDA software, so that just integrates the whole thing. And then you have AMD with its MI300 chip. So that's now starting to emerge as this lower cost challenger. So the training runs mostly in those big data centers where everybody's hearing about, they're sucking up all the power. These things are massive, and they're sucking up, all this data, and so they need these massive chips. And this process, it takes days or weeks for customers, and they need to pay, they want the fastest hardware. But then you get into the inference phase. And this is where you got basically the everyday work phase. So this is where, like your phone unlocks, based on your face or your thumbprint, or you got ChatGPT or Gemini answering your questions. So that's all inference phase. So the inference, it has to be cheaper. It has to be fast. It has to be energy efficient. And it's handling millions of requests per day on the much more modest hardware. So here in this phase, the competition is much wider. Yet, yes, we have Nvidia and AMD are in this space as well, but they've got a lot of competition here from Intel, Qualcomm, Google, Apple. So all of these guys are in on this thing. So the training chips, they've been earning big, rich margins today, and so that's where Nvidia's been, these massive earnings reports they've been giving. And then AMD has been gradually chipping away at that lead. But those are primarily the main players in that big training phase. But over time, what we see, we think the inference phase is going to become much larger market because as AI gets embedded into cars, into phones, into enterprise software, you're going to see a much more, much bigger audience for that. So for investors, for your listeners, where our strategy is, you want to look beyond just Nvidia, and you want to look as a diversified set of AI hardware and infrastructure plays if you want to get into that AI. And again, think about the future, and that's when all these data centers are built and all the data is there. It's now this inference where it's actually using all that data. What's your take on gold and silver?
Well, we like them both, certainly long-term for sure. Of the two, obviously gold's less volatile. It's kind of that, you can sleep at night metal. Gold's holding near its all-time highs, after that huge run it had. And so that tells you that investors are still nervous about inflation, about debt, and about geopolitics. And of course, we've got central banks are still big buyers of gold. And so that's signaling that, major institutions still see it as a core reserve asset. And it's not just some trading vehicle. Now, we've got the expectation that the Fed is going to cut. So there's a reason that the gold's been going up. It's up about $50 today. Lower rates, that typically weakens the U.S. dollar, so that helps gold. And I say it goes up $50 a day. It's last trade about 42.55. Initial support would be 42.25. So, and that's actually its 50-day moving average. After that, there's strong support at 3,900. So near-term resistance is 42.55. So basically, we're right at that. Again, so if we can break through that level, then it could take another rung at the all-time high at about 4,400. Now, with silver, today we had a big jump in silver. It's jumped about over $3. And so that's at a new record. It was at 56.70. Now, there was a technical problem on the CME derivative exchange last night or this morning. So that added to all the hype. And then on top of that, of course, you've got the reports of the severe supply deficit, and these major trading hubs in London and Shanghai. So again, that's creating a very tight market. So the supply crunch, that's exacerbated by strong, sustained demand. So like gold, lower interest rates, that typically weakens the U.S. dollar. That makes these dollar-denominated commodities like silver, it makes them cheaper for international buyers. And again, so that boosts demand. And again, as we talked, lower rates, that reduces the opportunity cost of holding these non-yielding assets like silver. So again, attracts more investment. And again, silver's got that dual role. It is a precious metal, but it's also a heavy industrial use metal. So you got, for the solar, the EVs, electronics. So again, it's got the dual play, and it is more cyclical. Now, also the advantage for silver for smaller investors, obviously it's much cheaper than gold, but it's also significantly more volatile. Typically silver outperforms gold in a strong uptrends, and it underperforms in a slowdown. So the price is influenced by both, you got the safe haven flows and you got manufacturing activity. So again, it makes it much more sensitive, I guess, to economic growth here. So it does fit investors who want more upside potential and are comfortable with bigger swings. So to me, the 50-day moving average has been very strong support for silver for the last year. That level sits about 48.50. As I say, we're at about 56.70 here. We could see a run at $60 here pretty soon.
What do you see for the U.S. and Canadian dollars?
Well, when I look at currencies, to me, currencies are such a key to everything that goes in the market. Whether you're talking currencies, the stock market, bond, precious metals, commodities, a lot of it just runs around the currencies, and certainly the U.S. dollar is the center of all of that. When the U.S. dollar is rising, other currencies and other things like commodities, et cetera, and gold, they tend to decline. When the U.S. dollar is going down, all of those other things tend to rise. So when we look at the U.S. dollar from its low in July, it's been on a slight uptrend, so it's been a nice slow uptrend. Now, we've got the expectations of the Fed rate cut in December, and what we talked earlier, that Trump's going to put in a much more dovish chair to replace Powell. So that could see the U.S. dollar start to turn lower. In the big picture, though, I say this all the time, all trade-weighted currencies are losing purchasing power, every one of them. And they're losing it together, and they lose it at about the same rate. Now, the U.S. dollar is the reserve currency, the world reserve currency. So, it's got that kind of main pole there where it's kind of a centralized currency for the world. So currently, you've got the BRIC countries trying to, wean themselves off the U.S. dollar, but that's not going to happen anytime soon. So while it will be under pressure with rate cuts, et cetera, so will all the other currencies. Again, U.S. dollar is the world's reserve currency. To me, it's that least ugly house on the block. So while it will have dips, I think it's going to hold its value relative to all the other fiat currencies. Now, Canadian had a nice jump today. We got that very surprising Canadian GDP data came out where Canadian GDP went up 2.6% annualized. I mean, that's wild. And that's after the last one, Q2, it was down 1.8%. this is where I get back into, do I trust Stats.Canada? I don't. The government data just flops around so much. But anyways, that's what it is. That's all we got to work with. Now, sadly, this great jump in our GDP, it wasn't from private investing or private sector. It was heavily driven by government spending, which is up a massive 12.2%. So that's telling you the money that Carney's government is just throwing out there right now, that's what's driving our GDP. So that, again, is not a sustainable long-term thing. Now, given the big jump in GDP, that pretty much ensures that the Bank of Canada will not cut rates in December. So again, it's all connected. So if we get the Fed rate cut and the Canadian Bank of Canada does not cut, we're likely going to see the U.S. dollar decline and the Canadian dollar rise. Bigger picture, the Canadian economy is much weaker than the U.S. We've got the Canadian dollar right now trading at 71.52. It's testing the upper rung of its downtrend channel. If it can break through that, it could maybe get up to about 72. Next support is 71.25. As I say, it's all connected, heavily driven by what happens to the U.S. dollar. So again, if the Fed cuts and most of the other central banks hold steady, we're likely going to see the U.S. dollar pull back and these other currencies rise.
The last few times you've been on, you called for oil to drop below $60, which it's done. What happens now?
Yeah, well, from what we had from August to late September, oil was trading around between 62 and 65. But then early November, it did drop below $60. Now, we got as low as 57.20 this week, but today it's having a bit of a bounce, so it's about 59.40 last I looked. So we're starting to get into the winter colder weather. I know in Alberta they got a bunch of snow this week. Northern, the eastern U.S. is starting to get colder. And then, of course, December is a very strong seasonal period for oil. But on the other side of that, you've got the peace talks with Russia and Ukraine. So we could see a lot of volatility in the next little while here, because if the markets believe that peace is achievable, then that opens the door for Russian oil coming into the market, adding to the already oversupply. Now, if peace talks break off, then that could cause a price to jump in oil. So all of this is very short-term volatility. In the bigger picture, we see oil prices in 2026 being much higher, likely in the $75, $80 range. Very cold winter would give oil a boost, and it would certainly give natural gas a good spike.
Bitcoin has been volatile lately. What do you see going forward?
Oh, yeah. My God. Well, one thing I've always say every time we talk about it, all investors must know that, cryptos are volatile. So, and we've certainly seen a lot of that in the last little while here. Yeah, after hitting its all-time high at 124K in August, it then fell back to about 107 in September, and then it jumped back up to even new high at about 126 in early October. And since then, it has sold off and it got down to about 80,000. So that was a 37% drop. And so that's what happened last Friday. Now today, this week it's been rallying up. So it's trading around, what we got here, about 90K right now. Now, if you're a swing trader, so that's a short-term trader, a week or 2 weeks, even a month or so, you can have some real fun with this. I mean, Bitcoin moves a lot. And if you're a trader, you can do really well. Just make sure you have what your entry points and your exit points are before you get in and get out. And, be sure to get out when it's time to get out. Longer term, we do expect Bitcoin is going to continue to become more of a safe haven play eventually with gold. Because there's the realization that with so much government debt globally, again, every country is massively in debt now. Fiat currencies are dramatically losing purchasing power. But near term, Bitcoin and other cryptos are acting much more like speculative tech stocks.
You have quite a few services, some paid, some free. Can you remind our listeners about each of your services and how they can take advantage of those Black Friday specials?
Oh, yeah, of course. So we have 6 services now. Like I say, 3 are paid and 3 are free. So in the paid, we've got Trend Letter. So the Trend Letter, that's 24th year we've been doing that. It publishes every Sunday night. It's for long-term investors who want to understand what's driving the market. It's regular $600 a year. With our Black Friday special, you get $200 off, so it's $400. Now that covers all sectors: equities, currencies, precious metals, commodities, and bonds. Then the second one is our Trend Technical Trader. Now that's an online service, updates every Monday, Wednesday, Friday. So now that's for both active or short-term traders and long-term investors. It started as a hedging service, but now it covers long positions. And again, it covers equities, precious metals, commodities, and it includes our proprietary gold technical indicator. Now that one's regular $650 per year, and it's on sale for $400 as well, so that's $250 off. The third one is Trend Disruptors for speculators with risk capital. Service covers disruptive ideas, so we're talking AI, virtual augmented reality, 5G, cloud, Internet of Things. That one's $600 a year. Again, with the Black Friday, it's now $200 off, $400 a year. Now, our free services, right now, we've got our new DeFi Digest service. So that reviews developments in the decentralized finance sector. So that's very speculative. People can sign up for that, and right now it's free. We will be charging eventually, but right now it's free. Market Pulse, that's a market recap. So that's where we highlight market moves of the day or the week. Again, that one's free right now. And then our headline service. So that's our free morning service, where what we do is every morning we see what's happening in the markets, and then we send out the headlines that we think all investors should be aware of. And then readers can either just read the headline, and if there's a particular item there that they want the details, they just click on the link and they can read the article. And so for any of those, just go to our, if you want to sign up for the free ones, you can just go to or send us a note at info@thetrendletter.com. If you want to get in on the paid ones and you want to get those great Black Friday specials, just go to our website, thetrendletter.com, and you'll see the banner there, and just click on that.
Martin, thank you so much for being on This Week in Money.
Oh, my pleasure, Jim. Thanks for having me.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. He was speaking to us from Coquitlam, BC. Coming up, Ted Dixon, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Ted Dixon, CEO and co-founder of InkResearch.ca, Canada's first online financial news and research service, providing insider news and knowledge to investors. His website, CanadianInsider.com, home of the Canadian Insider Club. Ted, welcome back to This Week in Money.
Jim, it's a pleasure to be back, and thanks for everyone listening in today.
When President Trump took office in January, you encouraged investors to come back to Canadian equities to position for better times ahead in Canada's private sector, with the Canadian Insider Index up more than 30%, including dividends so far this year, and the Venture Index up more than 50%. Have we seen a sea change in fortunes for the Canadian economy? And if so, can that good fortune continue?
Jim, I think the answer to that is a tentative yes. And fortunately for the Canadian market, not only do we have this tentative pivot to favoring the private sector by our policymakers, but we also have a stock market that is leveraged to new global trends that are developing post-COVID here, post-COVID, and there's a lot that's happened since the end of COVID-19, including the Russia-Ukraine war and everything that was has been wrapped into that. And that's kind of the lightning rod of geopolitical change we're seeing, and the Canadian market is well positioned to capitalize on these really secular trends that are going on. But in terms of the Canadian economy, which is what you asked about, the thinking back in January was a contrarian view, but that our policymakers weren't going to have a choice but to get our private sector more competitive, stop relying as much on the government sector. During the Trudeau years, we had massive growth in the federal bureaucracy, but that just wasn't sustainable when you're in a trade war with the United States. Like, you need to have a strong private sector that can stand on its own 2 feet, because at the end of the day, Jim, you need taxpayers to fund the government. You can't keep borrowing forever. I mean, the United States is in an enviable position in that they have been the world's reserve currency, and they still are in terms of market share. But Canada's not in that position, and we have to be mindful of our debt levels a lot more than the Americans. So you can't rely on just going to the debt markets all the time to fund your bloated government. That was good. That math was just going to come home to policymakers, regardless of their political stripe. And we saw that, I think, in the Liberal Party, which won the election. They moved from, the very, I would say, far left or further to the left, however you want to call it. I don't want to get hung up on labels, but they moved from the left to the center. Let's just put it that way. And I think we've seen a fantastic example of that this week with Alberta and Ottawa striking an agreement to pave the way for a new pipeline between Alberta and northern British Columbia to export Canadian heavy oil to Asia. And this is something that I think caught a lot of people by surprise. It was a pleasant surprise. And of course, I think, initially there is a well-founded reaction of skepticism, but given the reaction of the progressives and the environmental groups in the country, how upset they are, I think that alone signals that this is the real deal. Like, the Carney government is serious about backing this project to get at least one new pipeline built, if not another in terms of expanding the TMX further. So there could be 2 pipeline projects, a new one and the expansion of an existing one. We'll have to see how it goes. But just to cut a long story short on this pipeline issue, in terms of, how will we know if it's for real or not? The first benchmark that we're going to have to cross, or benchmark we're going to have to, see achieved, is the July 1st target to have an application made to what is called the Carney's Major Projects Office, where they need an application for a project, and then they will start the motions going to get the approvals going. So in that MOU, there is a July 1st target. Let's see what happens between now and July 1st. If no project shows up, then the skeptics will maybe well proven right. But given the amount of work that has gone into that MOU, I've worked in government in the past in the ministerial level. I've done political advisory work on a pro bono basis for at least, for one premier and other federal leadership aspirants. But looking at the work that went into the MOU, it's serious work, and it involved also the private. From what I can read into it, it also involved private sector input. So a lot of work went into the MOU. That's why it took a bit of time, I think. So the chances of this pipeline going through are pretty good. And that's an excellent example of what I was talking about in January, about how policymakers are going to have to shift the private sector. And this pipeline it says in the MOU, it's going to be privately funded. So, we will see how it all plays out. But in terms of direction, it's moving in that right direction. So that's a real positive for Canadian economy, and also will support Canadian private sector companies and Canadian publicly listed companies that are involved not only in the oil and gas area, but potentially also supplying all the equipment that's needed and materials and pipes for that project. So that's just one. It's a big example, but it's one example of the direction that policymakers, Jim, have been forced to go to. Whether it's by necessity or out of philosophy, at the end of the day, what matters is what's happening, and we're moving in the right direction. So that should also help support sentiment in the Canadian market. So I think that the Canadian market's looking good here. I think we are on a multi-year bull market for Canadian stocks. There's, this year there's been plenty of pessimism already, and we had an election, and I think that now we're starting to see some deliverables in terms of the Canadian economy. And then, as I mentioned earlier, there is just the entire geopolitical shifts that are taking place in the world, where Canada is well positioned, the Canadian market is well positioned because of our exposure to and not only energy, but also importantly minerals, both precious metals and industrial metals. They all have their place in this evolving geopolitical world, whether it's disruption of the global monetary system, where you've got China and BRICS countries leaning more on gold currencies than the U.S. dollar, and you've got also refitting of global power grids, not only for AI, but just for national security reasons, where you've got to have redundancy, you've got to have strength in your industrial, not only power systems, but also supply chains. So this is going to put I believe a secular bid under minerals and also precious metals. And so that's the big picture environment that's helping Canadian stocks. Will we have as good of a year in 2026 as 2025? Well, that remains to be seen how things go. Next year is a election year in the U.S., so that may throw some uncertainty into a lot of share prices, but we'll have to see. It's a bit early to start thinking about that. There's a lot of other variables as well. But over the next few years, the Canadian market is it's in the best position it's been in I think, many decades.
A big surprise this year has been the rally in Canadian oil and gas stocks despite a depressed oil price. Are insiders selling the rally? No. And if anything, they're buying the dips along the way. We wrote about this in our top 30 November energy report that's available on Canadian Insider. Essentially, we've been building the case for long life Canadian oil and gas assets since May, when we heard the CEO of Diamondback Energy worry about the sustainability of Permian Basin shale oil growth in the United States. And the more we looked at it, the more we saw concern that the U.S. oil patch's ability to keep growing production at its previous rate, was not going to be able to happen. I think there's a debate out there about, is shale oil production booming still, or growing, or is it peaked? I think even if you take the bullish case where it's still growing, it's not growing nearly at the rate it was. I think that is pretty obvious at this point. Yes, you could have another technological a tailwind that changes that, but at this point, it's looking like U.S. oil production
out of the onshore oil production not only has a growth peak, but some of the data that we've looked at, and we reference this in our top 30, there's actually some evidence to suggest that the oil production, when you take out all the condensates, all these extra natural gas plant liquids that the Energy Information Agency out of the United States includes in its weekly numbers, when you try and separate that out, and it's not an easy process, so I mean there's uncertainty around that, but looking at the numbers that we've seen, we actually see crude oil production, excluding all those condensates, is actually on the decline. So we'll see how that plays out. We do hear a lot of concern about global demand, and China gasoline demand is peaking, and that may very well be true. But you've also got the rest of the developing world that is in growth mode. They're going to use more energy, more oil and gas, not less. It may not be at the clip they might have been, 2 decades ago, in terms of if they were at this, under the same circumstances. But they're still going to need more, and we see demand for other refined products as well. So no, even if gasoline demand is not growing at the same clip it used to, we're going to see demand for other products. So energy demand is likely to continue, and time will tell how fast that growth happens. But so the debate, though, has been all around this sort of, when's peak oil demand? Where's peak oil demand? But very little debate has been given to about, well, what happens if U.S. oil production growth has peaked, and in fact, what happens if it's plateaued? So I think that's what's really helping Canadian oil and gas stocks here. And this news that we've got on the pipeline project, the new pipeline, is just icing on the cake. So, the oil and gas stocks, the Canadian energy sector has had a surprisingly good year. It looks like it'll finish the year up double digits right now. Let's see just looking at what I see in terms of the energy index in Canada is up 15%. So that's lagged the Canadian Insider Index, which is up over 30%. And the miners have been the big winners. But maybe next year, who knows? Maybe energy may actually take the lead. But double-digit returns are still pretty good, right? Given that all the pessimism, and I still see people making the case that, well, this is a bubble, or it's a top, and the Canadian energy stocks have to come down because oil price is so low. Insiders continue to be upbeat. And amazingly, they've been oil and gas sentiment amongst insiders in the exploration areas continued to advance all fall. Our oil and gas exploration and production indicator is over 200%. That means there's twice as many stocks as key insider buying as there was selling over the past 2 months. I would not expect to see that if insiders thought that this was overdone. If anything, it just reinforces my view, which I talked about earlier, that we're in a multi-year bull market for Canadian equities.
Did insiders buy the recent pullback in gold miners?
They did. They did. The insiders have been bullish, particularly on the junior names, for a prolonged period. So the reaction to this recent pullback has been fairly modest, but still positive. And when I say positive, I mean over the last 30 days, the ratio of key insider buying to key insider selling on the venture in the venture exchange is over 3-to-1. So that's still pretty high. Now, as we entered the year, it was more like 4-to-1. So it's not as high as it was, but it did pick up as stocks came off their October October highs. And, I even noticed it at Inc. We saw people, some people quit their subscriptions in late October, and, we didn't see very many people wanting to sign up. It was almost like everyone thought it was over, and I was like, no, this is just a pullback. And so it's amazing how some investors can get shaken out by a pullback, but no, we saw a nice uptick, and in fact, just looking at how our indicator has behaved on the venture side, it behaved as we would have. It kind of peaked here around the time. Looks like we've seen venture stocks put in what looks like a floor or a support level in November. So, it's looking pretty good, and we've written about some of the leaders in our top mining report, which we just published on Friday for November. There are a number of larger producers who are made 52-week highs this week, and there's been more on Friday that have made 52-week highs and some all-time highs. So it looks like this period of consolidation we've seen since early mid-October looks like that's coming to an end. Judging by the number of stocks that we're seeing now, they're just like one day at a time. Like every day, there's more and more that are like breaking out to new highs. So that is a good indication, I think, of the sustainability of the precious metals rally. And we made the case again in this top mining report as to why we believe that is so. And we tried to put the fears to rest that this is just a short-term rally and that it's peak. We've given three reasons why that we would look for in terms of signs to say, oh yeah, it's we've had this gold rally, precious metal rally, it's now over. We think there's three conditions that will be required for the precious metals rally to run out steam on a long-term basis. I'm not talking short-term. I'm not talking about pullbacks or, short-term overbought. I mean, there are lots of technical analysts. You got a good one that you feature regularly here, Ross Clark, and there's others, and it's not an endorsement of any one technical analyst's work, but if you're looking for technical ideas, the insiders can give you an indication maybe when you're at near the top or the bottom of cycles. They're not going to give you these little kind of 1 week, 1 month in and out swing trade. That's not what insider information can be used for. It can be used to look at opportunities that come up. Sometimes they do come up towards the bottom of cycles, but it's not really a tactical tool for investors. It's a sentiment tool, and it's an investigative tool to help with your investing and to help you ensure that when you do your due diligence for a company, that the insiders are putting their money where their mouth is, and when are they doing it, to give you an idea of whether you're in a window of opportunity or not, or whether you should be considering taking money off the table. And in our view, and putting my experience in terms of my past work in government and in the policy area, putting that together with the work I've been doing for more than 2 decades now at Inc. Research and experience as a foreign exchange dealer at a Canadian chartered bank, putting that all together, I see 3 big necessary conditions to end the gold and silver rally, and we are nowhere near those. And I'll give you this is the first one. As we say in the report, there's not even a point talking about the other 2, because the first one has to be fulfilled, and that is a credible path for U.S. deficits to head back to 3% of GDP or lower. Well, right now we're still kind of at 5.5% of GDP, and there's no policy path that you can hang your hat on and say, oh yeah, look, I can see what they're doing in the U.S. They've got this plan. The deficit is going to come down. The plan right now is to keep the deficit under control, and it's under control in terms of like not getting extraordinarily high in relation to the economy, but running the economy hot by having high nominal GDP. And what that means is, you're going to need some inflation to kind of layer on top of the real GDP growth to keep the nominal GDP high, because the debt to GDP ratios are calculated using nominal GDP. Usually, when you hear these headlines in the media about the GDP went up 2% or 3%, that's real GDP growth. Well, what I believe the Trump administration wants is more like 6% nominal GDP growth. The more, the better. And so, we believe that inflation is actually a feature of U.S. fiscal policy. It's not a bug. And all this talk about, the Fed, talking about, we're really concerned about inflation. Yeah. Well, that's there. Of course, they have to say that, but it's been running above their target now for many years. So, fool me once, fine, but fool me twice, shame on me. Never mind 3 or 4 times. The Fed is letting inflation run above target, and there's a reason for that, and that is because it's the only way right now to politically keep the U.S. debt to GDP from getting completely out of hand. So by keeping nominal GDP growth hot, then they can at least try and keep it in this kind of, so far, in a level that capital markets seem okay with. We haven't had any major problems in the U.S. Treasury market like we saw in the UK with Liz Truss when she brought in her lower tax growth budget. We haven't had a Liz Truss moment in the U.S. Treasury market. However, there are little hiccups from time to time in these Treasury auctions. Sometimes they don't go as smoothly as I think the policymakers would like. And interestingly, as we write in our report, our top mining report for November, Trump's new appointee to the Fed, Stephen Miran, he's got a lot of ideas in terms of where he thinks the Fed should head. And one of the ideas he threw out there was, maybe the Fed should be paying interest on the U.S. government's checking account, which is very interesting, and kind of muses that because that would help around these treasury auctions. Like the Fed could kind of, what he says, sterilize these auctions. If there was like a bit of a hiccup with liquidity, well, he calls it sterilization. We've called it the Miran jitterbug, based off of the Roaring Twenties U.S. swing dance. We'll see if what happens as a new Fed chair comes in, whether they start doing these little innovations where we can see the Fed, providing a more helping hand to these Treasury auctions, and as the Trump administration, tries to run the economy as hot as possible.
What is insider behavior telling us about the outlook for dividend stocks?
Right. So this is a little bit more complicated, I think, for dividend investors, because a good economy is great for keeping a dividend sustainable, on average. But if inflation gets too high, then the dividend yield may not be so attractive, because inflation eats away into it. And particularly if you start seeing long bond yields moving up. Now, I wrote about the telecom sector in the Globe and Mail just earlier in November, and they pay dividends, and that's been a sector in Canada that's been very tough, a very tough business, because we had a big surge of immigration, which helped the telecom companies, but then the government capped the inflation, the immigration rate. So it's made it a lot tougher for these telecom companies to get new customers. So so there's an example of a situation where you really have to, I think, look closely at each company, how they're dealing with tough situations. So we're looking at dividend payers one name at a time. I think in this environment where you've got a mix of potentially elevated inflation, but potentially strong nominal growth and a recovering Canadian economy, you're going to have to look at these dividend payers one by one.
Are you offering any sales this holiday season for the Canadian Insider Club?
We are. Over the next few weeks until the end of the year, you can subscribe to the Canadian Insider Ultra Club and get 50% off your first year annual membership by using the coupon code YES26, YES26, and that'll get you 50% off, and you'll get access to Core Inc. research reports, have them emailed to you, insider filings, and you get rid of all the ads on our website too if you sign up. So that alone will make the experience worth the subscription. So check out CanadianInsider.com over the next few weeks.
Ted, thank you so much for being on This Week in Money.
Jim, thanks for having me back.
My guest has been Ted Dixon, CEO and co-founder of Research.ca, Canada's first online financial news and research service, providing insider news and knowledge to investors. His website, CanadianInsider.com. You can find him on X at Inc. Research. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Josef Schachter, Martin Straith, and Ted Dixon. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.